So we're going to look at the 2018 paper on break-even point or CVP. So we must understand that break-even point is one of the most important tools that is used in financial management. It's used also in managerial economics and management accounting. So we use CVP to determine the level of output at which the total revenue is equal to the total cost. It's simply a point at which profit is equal to zero. So a quick recap of our notes that we had, we simply explained that the point at which total revenue is equal to total revenue, total cost is our break-even point when we make a zero profit. So managers will use this to understand how much they must sell to recover their costs when starting and earning profit. So break-even point matters because it's there to help identify the minimum level of activity to avoid losses. It helps assess the impact of price, cost, and volume changes on volatility. It helps to set realistic targets and pricing strategy. It also helps in making decisions as to whether to expand, cut costs, or adjust prices. So the concepts that are embedded in this CVP as follows. You must understand that CVP is very applicable. It's not like financial accounting where you have standard formulas that are used. Okay, so the concepts that we must understand here are fixed costs. What are they? Marginal costs. What are these? Total costs. What is the contribution? So the fixed costs in this case entail costs that do not change with output. Okay, these are costs that do not change with output. They're constant. The variable costs is simply costs that vary with output. Okay, they increase with each unit sold. And the total cost we're looking at, total cost is simply fixed cost plus variable cost times quantity. Selling price is simply the amount received from selling a unit. For instance, 3 kwacha per orange. Total revenue is the income that comes from the sales. It's simply given by the selling price times the quantity. The contribution is simply the portion of the sales that contribute to covering the fixed costs. So contribution is simply selling price minus variable cost. And the profit is simply the remaining revenue after all costs are identified and deducted. So profit is simply total revenue minus total cost. The break-even point is simply the point where sales level of revenue is equal to cost. Okay, so our break-even point is our point at which the contribution is multiplied by the quantity. That is our break-even point. Okay, what other formulas should we know of? So these formulas you're not given, you just need to know them. Okay, these formulas are not given, you just need to know them. So we also have the margin of safety. How do we find the margin of safety? And how do we find our the margin of safety is simply the actual sales over the break-even sales. That is a margin of safety. So the amount by which sales can fall before the business reaches break-even. Then the targeted sales profit, these are a number of units that we need to reach a certain specific profit goal. So it's simply fixed cost plus targeted profit divided by contributions. And the graphical illustration is we have units here and we have our total costs here. Okay, our fixed costs are fixed here. Our variable costs, they vary. When we combine these two, we're going to have our total costs here. Total costs will start from here. So this total revenue line starts from zero, tries at a constant rate. The break-even point is the point at which our profit, our total revenue is equal to our total cost. So where they meet here is the break-even point. When our total revenue are more than our total cost, we call it a profit. And the loss is simply a negative profit. So our point where our total costs are more than our revenues, that is called our losses. So at point Q, that is where our break-even point occurs. It's a point where we neither make a profit or a loss. Okay. So this is what we're just looking at quickly for those that have joined. So the notes of the formulas that you need to know generally are here again. So contribution, what did we say? Is simply our cost price minus variable cost. It tells you each unit's profit before covering fixed costs. And the break-even in terms of units is simply the fixed cost over contribution. It tells us how many units to sell to break even. And we also look at the break-even value. It's simply the break-even units times selling price. It's simply the value of units sold required to break even. The margin of safety in terms of units, simply the actual sales minus a break-even unit. So these are extra units above the break-even point. Then margin of safety percentage is simply the margin of safety in units over actual sales times 100. This is expressed as a percentage of the actual total cost. And targeted profit is simply the fixed cost plus targeted profit over contribution. So it looks at the units to reach a desired profit level. And we also have what? Our new break-even sensitivity. So it's fixed cost over new selling price minus new variable cost. So it is used if CVP or variable cost change. So understanding the assumptions and in the event that they are obliterated, you can make an adjustment in that course. So bearing that in mind, we'll go to our question. Are we together so far? Is anyone left behind?
Just a question.
Yes, please.
Why are they calculated in units? Like the break-even points, they are calculated in units.
Break-even points are calculated both in units and in value. So break-even point
Okay.
is the point at which you want to, if you're selling oranges, you need to know how many units I'm going to sell to neither make a profit or a loss. It can also give you a value term in terms of how much you must uh, sell in quarter to neither make a profit or loss. So you can do it in both ways. Is that clear? Okay. So these are the formulas you must write on a piece. I've sent you these formulas in the group. So this is the standard 6 method procedure for understanding everything. So even before you calculate, you can do everything in advance. They correlate. So they're transitive. So contribution, you have selling price minus variable cost that looks at what contribution per unit. After finding the contribution, you divide the contribution to the fixed cost. What you get is a break-even unit. So it looks at what the break-even point in units. Then you multiply that answer times the selling price. What you get is a break-even. You're converting it into sales value. Then after you get the break-even value, again, we can use this, the actual or budgeted sales, we subtract the break-even point to calculate the margin of safety. Then we get the margin of safety itself. We divide it by the actual sales times 100, we get the margin of safety percentage. Okay, they're following each other. Then to find our units for the target profit, you add the fixed cost plus the profit over contribution. You're going to estimate the units to meet what? To meet the profit goal. So these formulas are very important to get your 20 marks in full. The other 5 marks are theoretical. Is that clear? So please, you have no option but to memorize those important formulas. So let's look at this exam question here. Okay, let's look at this exam question quickly. This question shouldn't last more than 10 minutes to do when it comes to you. Okay, so we're told that Lukata is operating a small-scale enterprise involved in selling oranges to Lusaka, Challenge South. With the assistance of a friend, has prepared the following. Number of oranges sold per year, 48,000. Selling price per unit, 3 quarts. Variable cost, 1.5. Transport, rent and other fixed expenses 30,000. Calculate the break-even point in quantity and monetary value formats. Calculate the margin of safety in units and percentage. So these ones here, we remember how do we calculate these 8 marks are assured. How do we get the break-even point in units and value? Okay, so we've been given what? All the data that we need. So the contribution is simply selling price minus what? Variable cost. So what is the selling price? 3 quarters. What is the variable cost? 1.5 quarters. Let's subtract these two. So our contribution is 1.5. Is that clear? Anyone lost on contribution? We're clear. So the significance of that is simply it measures what? It means each orange can be sold and it contribute 1.50 towards covering the fixed cost. Okay, then we go to the break-even point in units and break-even point in what? In a percentage. Who remembers the break-even point in units and in percentage? The formula. I was just giving you the transitive way of doing all this quickly. So break-even point in units, we simply now divide the contribution that we just calculated into the fixed cost. Okay, and what was our fixed cost? Our fixed cost, according to our question, is 30,000. So 1.5, the difference between these two into the 30,000, that is what we get as our what? As our break-even point in units. So we get 20,000. So we could sell 20,000 oranges to cover all the costs at which there's no profit or a loss. Then what is the value of these 20,000 units of oranges? You multiply this one by the selling price. 20,000 times 3 kwacha, we get 60,000 kwacha. So 60,000 kwacha worth of sales are needed for us to break even. Then we now use that formula. What is our break-even margin of safety? So it's simply the actual sales over the break-even units. So our actual sales, we were given, they're usually given the budgeted sales. So what's our actual sales? Okay. What is the actual sales? 48,000. When you divide this by the break-even units that we calculated. All right. So for the 8,000, you divide, you subtract the break-even units. What is the break-even unit? 20,000. So we get 28,000. That is our margin of safety. Then in terms of percentage, we divide, okay, our margin of safety percentage divided by our actual or budgeted sales, 28,000 over 48,000. So we get 58.33%. Is that clear? This is what we just looked at. Are we together or I'm a little bit fast for you? We're together. All right. Thank you.
Just a little bit fast, but we.
All right. Okay. So we were just fusing in everything from what we just learned. So percentage and value terms, 8 marks. All right. So calculate the number of units to be sold in order to meet a profit target of 60,000. Okay. So whenever you are given a target, anytime you see you're asked to give a target, the profit, the required contribution is slightly manipulated. We just add the total fixed cost plus the targeted profit. Then we divide the answer by the, okay. So what is the formula for units for targeted percentage? Who remembers? Fixed cost plus profit over contribution. All right. So don't forget these formulas. So what was our The targeted profit, we have fixed cost plus profit divided by contribution. And in this case, what was our fixed cost and what was our profit and what was our contribution? The fixed cost is 30,000. We add the targeted profit of how much? 60,000. Okay, we divide by the contribution. Contribution was what? 1.5. So fixed cost 30,000 plus 60,000, that's 90,000. 90,000 we divide by a contribution of 1.5. What do we get? 60,000. So you calculate that. That becomes our contribution. So we add the fixed cost to our targeted profit. So our fixed cost was 30,000, and we're told that we desire a profit of 60,000. So we divide this by our contribution, okay, over contribution. So 1.5, which was the selling price minus variable cost. Is it clear on how the 60,000 has been calculated? Is it clear? All right, so we are at 10 marks. Number D, calculate the break-even point if the selling price was increased by 15% and the variable costs were reduced by 2% and the fixed costs remained unchanged. 6 marks. So this one has some adjustments to be made. So we want to calculate what? The break-even point with the assumption that our selling price increased by 15% and variable costs reduced by 2% and the fixed costs remain the same. So we need to calculate our new, we need to calculate our new break-even point. All right. So I repeat, what changes have we made? Selling price has increased by 15%, variable costs have reduced by 2%, the fixed costs have remained unchanged. So we need to calculate our new break-even point. So let's first adjust the prices. So we must understand that there is an increase by 15% from 100%. You just add 15% to 100. So 15 increased by 100%, so meaning we're going to have what? 1.15. Can somebody now guess if the cost, variable cost reduced by 2% from 100, what do we remain with? This one is a tricky question you need to understand. Okay? If everything is assumed to be at 100%, so if we increase our selling price by 15%, it means our new selling price will be 1.15 times the actual. If we reduce by 20% from 100%, which is 80% divided by 100, 0.8. So that is what you should know, all right? Then our contribution we know is simply our selling price minus variable cost. Okay, so we are given to suppose the following. Number one, our selling price will increase by 15%. So just add 100 plus 15, it's 115. And divide by what? By 100. In short, this is just some arithmetic. So you're going to get 1.15. Okay. Then the variable cost reduced by 2%, that is 98%. 98% divided by 100, what do we get? 0.98. So we adjust the prices based on the percentages. So our new selling price will be 3/4 times 1.15, we get 3.45. Our variable cost was initially 1.50, so it reduces by 98% by 2%, so we multiply by 0.98, so we get 1.45. So these are the new adjustments, selling price and variable cost. Okay, so our fixed cost still remains the same. It is what? 30,000. What is our formula for our break even? It is simply the fixed cost over contribution. So contribution now will be selling price per unit minus variable cost per unit. So you're subtracting 3.45 minus 1.47. So we get 1.98. So we divide the 1.98 into the 30,000. So what we're going to have is 15,151.52 units. So this is the break even in terms of units. In terms of value, you multiply this times the selling price, which is a new selling price here. So 15, 15, 15 times 3.45, we're going to get 52,275. So meaning the break even after us selling 152 oranges with 52,273. So this is how we would calculate that. I hope that is clear now. All right. So your homework will simply to reattempt this question. All right. Please reattempt this question. It is a full 25 mark question. I don't want you to miss. This is coming. It's better than a financial statement. It's very straightforward. Are we together? Okay, so we're going to QM. That's at 8 hours. Thank you so much for your time and have a good day.